Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, July 26, 2024. This week, two important economic indicators confirmed what Wall Street has been expecting for the past month. Yesterday, we learned that the U.S. economy, as measured by gross domestic product, grew at an annual rate of 2.8% in June. That is exactly double the 1.4% annual growth rate recorded during the first quarter. And here's that report. I have a link to it here in the body of this article. And you can see the bar graph here. And you look all the way out to the right. The bar on the far right is the second quarter of this year. And you can see that it's twice as tall as the one for the first quarter. And is actually, on average, maybe a little bit above about the past 6 or 7 quarters, with the exception of the third quarter of 2023. So that was an unexpectedly strong result and a good number. Now this morning, the Personal Consumption Expenditures, or PCE, price index report for June reinforced the notion that inflation is slowing down at the same time. Last month, the PCE price index increased 2.5% over the past year. That is lower than the 2.6% figure for May, which in turn was less than the 2.7% result recorded in April and March. So also here's that report, and you can see the trend there, 2.5 in June, 2.6 in May, and so on. And if you click on current release, they then break it down into the different categories. So there's a link to that report as well. Now, the combined implication of those two results has Wall Street convinced that the Fed will reduce its policy rate in September, assuming nothing else comes along to upset the apple cart. The bond market agrees, which is why the yield on the 10-year Treasury note is back down to 4.2% after beginning this month, near 4.5%. So here's the yield of the 10-year Treasury note year to date, and you see it steadily climbing all the way through about the end of April. And then declining, but with some spikes upward here. The most recent spike really on the very first day of this month, where that day the intraday high was 4.49, just a tick below 4.5. But then if you come way over here to the right, you can see it coming back down. Now we'll get a better read on that this Wednesday when the Federal Open Market Committee releases its next policy statement. Although it is not likely that it will reduce its policy rate next week, Fed Chair Jerome Powell is expected to signal that a rate cut is imminent. Meanwhile, the stock market resumed its upward trajectory today after falling in the wake of disappointing quarterly results from several mega-cap tech companies. They were overvalued to begin with, and their outsized influence on the cap-weighted S&P 500 index all but assured that a pullback was inevitable. However, the equal-weight version of the index has gained ground during the past week. So I'm going to show you here the RSP, which is the Invesco S&P 500 equal-weight ETF. Now that's year to date, and you see the big spike over here starting at the beginning of this month. It's up 4% since the start of this month, while the Spider S&P 500 ETF Trust, which essentially mimics the cap-weighted S&P 500, has broken even. So I'll show you the past month for the RSP, and you can see over here on the left, it's considerably, 4% lower than the heroes on the right. But if we go over to the S&P 500, cap-weighted, the SPY, and we look at the past month, basically it's maybe, almost exactly where it started the month. In short, this is precisely the scenario I described on page 2 of the current edition of Personal Finance. As I said then, I believe that now is a good time to build positions in mid-cap and small-cap stocks trading at low multiples. That is why I added oil producer APA Corp. And Hewlett-Packard Enterprise Company to our growth portfolio this month. The second half of this year is shaping up to favor stock pickers over index investors, and there is still plenty of time to get a seat at the table. Thank you.